Hey, good evening, guys. Welcome back. If I tell you there were very three signs clearly on today's price action, which was indicating that market could witness a very sharp pullback, would you believe? So today I'm going to show you what signals you should look when extreme market rallies, either up or down, and that can help you, trade in a more efficient way. So stay tuned. So let us discuss about the few couple of weeks back when we saw divergences, we saw negative distribution, we saw that the market was having some sort of signals and indicators which we follow that were giving a sign that the market can actually pull back in a near term. And I think from Friday onwards, I was very vocal in terms of my view that the Bank Nifty can tank easily 2,000, 3,000 points. And if you haven't seen that video, please click on this card and just see how we have played it, using the option strategy in the Bank Nifty. Now, coming to today's price action, it was a very fantastic price action today. There were three to four signals which were indicating that we are likely to get the pullback, and pullback can be very swift. Now, why am I using a pullback and why I'm not saying that the entire trend can reverse? We'll see to that in a while. Okay, so first, market was extremely oversold when it came to today's 200 point down Nifty. So after opening about a sort of a 90 odd points negative, then we saw a very sharp sell off and we breached the support of about a 14,500, I guess. Yeah, after that breaching support, the selling has accelerated. It has gone into a region which was an extreme important level. I'll tell you that in a while. So first, there were oversold readings on the hourly charts and 30-minute chart. Okay. Second, when market fell, it fell to a level where there was a support, and that support is basically the gap area. So if I have to show you the gap area, let me just pull up a chart. This is the Nifty chart, and you went right there. This is the first Fab uh, candle, and on the first Feb candle, the high was somewhere around about 14,398, and if you see today's low, that is 14,371. So what happens is that previous resistance becomes the support. That is a price action theory which you can follow in a very simplistic manner. You probably figure it out if you read few books and understand. So that was a gap area, plus that was a very strong resistance in the past which market could not clear it, and that is where when we went we took a support. So first, markets were oversold. Okay, there was divergences. Second, market went into the region where there was a gap area. Third, very important, and that is where our expertise lies, there was an extreme oversold reading from a put call ratio, and intraday call writing was so heavy that it almost gave a clarity that if there is any minor pullback also, the call writers are likely to get uncomfortable. We saw a huge call writing in a 15,500 call option, 14,500 call option. And when market starts recovering, you see them, driving the rally. Now, these days, one of the important thing which I'm noticing and which is a driving factor often is that option writers and how they change the stance gives the direction to the market. Now, mostly the option writers are on the right side of the trend, but whenever it reverses from the key support or resistance zone, opposite side writers. So, for an example, market is going and the put has writing has taken place. Now, if for some reason market breaches this writing level, we see the panic selling coming in. Today was the same thing on opposite side. Market was falling and writers were writing the very heavily, 14,500 call option. And as soon as market recovered above that level, those call writers were the first one to cover their position. And that is why we saw a sharp pullback. And trust me, what I have often seen is that this is the kind of a shakeout which is very common these days. And that is what, reason, in my opinion, of a market to recover. Now, along with that, you also have to understand that sentiments are best reflected in your optional analysis. And what I have often seen is that whenever we get that extreme or high readings on the put call ratios of open interest and volume both, we tend to get a reversal. So whenever you see a bank nifty put call ratio below zero point 0.6, you've got to be very, very careful about that. And whenever you see a nifty put call ratio around a point 0.8, point 0.9, you got to be very careful about that. And that is where you get the kind of a bounce back. Now, time to time, what I have often seen is that sometimes you have to track the sentiments on the social media also. Like often I have seen when people are too gaga about the one side of the trade, and that is where the it reverses. So not to say absolute contrarian, but sometimes what happens at an important level, I have seen that majority of the people may have a directional bias, and when it reverses, it often triggers the most of the stop losses. So three reasons which I was able to find out, and probably we traded also. And last one I have saved it. I'll tell you in some time. First, we went to the support area, and there was a gap. Second, there was a beautiful divergence on the 30-minute chart. Third, there was a huge oversold reading on the put call ratio, and we saw excessive call writing at a 14,500. And the market reverse, those guys were the one who covered the position. Now, fourth reading, it was a very beautiful reading and it came later. So what happens when market reverses from the lows or from the top? The first leg is often going to be the one which propelled by some sort of a covering. After that, there is a pullback, and that pullback is the B leg or probably the second leg of a a larger pullback. That forms the formation which is called inverted head and shoulder. And I'll write a description of a reference to where you can probably read more about it. But inverted head and shoulder is a formation which has formed today on 15-minute charts, and it was so beautiful that it almost gave a clarity that the right shoulder was indicating that the market could be a 200 point odd up, and that is what has happened. So if you remember, from a minus 200, when you came into the positive, and after that again when you went to minus 50 odd level, that is where the inverted head and shoulder has formed. And when the inverted head and shoulder has formed, and after when we saw the breakout, I think that was a very clear. So if you were a day trader with us, if you were trading live with us, or if you would have seen this kind of a reading, probably you would have done a long bet today. And not to tell you, like I was short since last Friday, and from about a 35 500, and we were expecting a huge fall, so that was going well. So I hope today's video has helped you understanding that how you should understand about when the trend is extended on a one side, what are the readings you should look for. Thank you so much for watching this video. Have a good day. Bye bye.